Welcome everyone to this Tuesday edition of Inside India. I'm Sri Jegarajah. Here are your headlines. India's market rally rolls on, the Nifty hitting its highest level this year thanks to continued tailwinds from the RBI and optimism about US-China trade talks. But as the RBI's rate cut pressures bank deposit rates, India's retail investors are turning to the high-yield corporate bond space for better returns. We'll talk about that. And Tata Motors has a $4 billion five-year plan to stay in pole position in the EV game. Asian markets looking sharp, and there is optimism in the air in sentiment in the global markets, including out here in Asia, that there could be some substance associated with the US China trade talks that are underway in Europe and London specifically this week. So the TAIEX, the clear leader at this juncture, up by 2%. Australia is putting on 0.8%, and the Nikkei up by 1%. So markets broadly some confidence there. We are pretty scant in terms of detail regarding those closely watched US-China trade talks held in London yesterday. More talks are expected today. CNBC's Megan Casella has the reaction from the United States.
Talks had wrapped up for the day between the U.S. and China in London. That was, by my estimation, some 7 hours of trade talks, and my source says they are set to resume again tomorrow morning, London time. This, of course, comes after Kevin Hassett told CNBC earlier today he was expecting a short meeting and a strong handshake. No evidence of either of those yet, but of course talks are ongoing. And also just in the last few moments, Scott, President Trump was asked if he'd gotten any update from his negotiating team over there. Take a listen to what he said.
I think we're doing very well. They're over there now. I'm only getting good reports. It's a little early, but they'll be calling in soon. In fact, probably when I get back, I'll have my first call from them. We want to open up China. And if we don't open up China, maybe we won't do anything. But we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
The president then went on to sidestep a question about whether he had authorized his Treasury Secretary to ease up on export controls against China in these talks today. He did not directly answer that question, but that refers to a Wall Street Journal report earlier today saying Bessent had been authorized to take steps in that direction. And, Scott, that just gets to what the heart of these talks this week is the Chinese want to see export controls eased up against things like jet engines, chip software as well. That's the kind of thing that they're looking for, while the U.S., meanwhile, is looking for rare earth exports to start flowing again. So both critical issues here for both sides. Nothing easy to get down on paper, but they're looking for that handshake agreement, and we know they'll get started again tomorrow morning London time.
US and Indian negotiations are also happening concurrently. The Indian markets come online in about 45 minutes. Now, the Nifty did hit a high for the year in yesterday's session on Monday. Here's what GIFT Nifty futures are indicating. So it looks as though the halo effect is likely to continue. 25,243 is where we're expected to kick off. So that would represent about 150 points or so of upside, continued momentum post-RBI, and something of a halo effect. Dollar rupee at 85.6420. Checking in on India's government bonds, again, post-RBI, a lot of interest in the shorter end of the curve after that 50-pointer and also a cut in the CRR. Let's take a look at the two-year bond yield at 5.646. Let's get more on this and bring in Tanvir Sethi, Executive Vice President of Investment Management at Kotak Mahindra Asset Management Singapore. Tanvir, very good to see you on the programme and welcome. So, all in all, how did last week's 50-pointer and the cut in the CRR and the shift in the policy stance towards a neutral bias, how did that shift the narrative in the fixed income space?
Actually, thanks for having me on your program. So this is a very interesting question as to how we are looking at it and how the market has looked at the RBI's policy last week. At one end, it was a bonanza policy. They've come back and delivered a mega 50 basis points rate cut. They've also come back and delivered a 100 basis points CRR cut to commence from September over the next 3 months thereof. In all, I would say this is more like a north of 75 basis points rate cut. So it was a very big boost from the rates perspective. But on the other side, they came back and disappointed the markets, saying that they are changing the stance from accommodative to neutral. They've come back and said that there is very limited scope for RBI or the MPC to come and support from the rates perspective hereof. So the rates are now pretty much anchored at 550. And some of us, like other market participants, thought in this cycle the rates could have been as low as 5, maybe 5.25. So that was a little bit of a dampener, and the bond markets clearly gave their verdict. After a brief rally on a net, the rates sold off. They were higher for the day. And while we speak, the 10-year is closer to 6.35. So obviously this has been seen as a net negative. So why did RBI do that? I suspect that it was to protect the currency. They're a little afraid that with the excessive rate cuts, with the interest rate differential coming down, the currency may take a beating. And somewhere down the line, maybe their excessive or the high foreign exchange short book that they have, which they probably want to unwind. That is something that is playing in their minds as well. So I suspect that they basically come and said, here's the deal. This is big amount of rate cut that we are delivering over to the banks hereof to take care.
And it was significant. We're talking about 2.5 trillion rupees injected into the system through the CRR reduction, right, Tanvir? That represents one of the largest liquidity infusions in recent years. And I believe, please correct me if I'm wrong, that the last time we saw this type of action of this magnitude was post-2008 financial crisis.
Absolutely.
By that metric, does that concern you? Does that suggest that there is something troubling on the horizon that the RBI perhaps want to preempt in the domestic economy?
No, I don't think there is any worry per se. But yes, we too were surprised with the magnitude of both coming together, right? Just not the CRR, but also the rate cut. Having said that, of course, it is prospective. It is not overnight. It is in a phased manner. I think what the message the RBI is giving is that liquidity was a constraint towards the end of 2024 and early 2025. Since then, they've come back and handled it very comprehensively. We already have been hovering around the 1% NDTL often take in the recent past. And with this, the durable liquidity should be north of 2, hovering closer to even 3% over the next few months. So I think basically they are ensuring that the liquidity is ample so that there is no reason for non-transmission of these rates. I don't think they are really worried at this point of time.
I see. So tactically, Tanvir, post-RBI, knowing what we know, does short duration make sense?
Yes, absolutely. I mean, with the rate cut cycle supposedly come to an end, there is lack of duration play at present, one would say. But I wouldn't write off duration altogether. What one must see is if you dial back a few years ago, RBI had indicated that the comfortable neutral real rates of around 1.4 to 1.8, 1.9%. And if we take the projections of 3.7% inflation for the year, and against that, when we look at 5.5%, we are at the upper end of this neutral real interest rate. So as such, RBI does have the capability to cut rates. The bar is much higher. Yes. I think there will be multiple cues that we have to look at. One is, for now, when you look at the US real interest rates, they are also at similar levels, right? If you, for instance, if you take core PEC hovering around 2.5% versus 4.5% for the Fed rate. And as this inflation were to edge up, which we do expect, Maybe if their economy came in slower towards the end of the year and they had a few rate cuts, as that number goes down, that will give some additional leeway to RBI. Lastly, let us not rule out that there are some sectors of the market, some economists who are actually projecting CPI to go to as low as 2%.
Yes.
So there could be some more scope, but the bar is high for sure.
Understood. Tanvir, there's been a fair degree of interest domestically in corporate and MBFC bonds. What is that telling us? And just how compelling is the risk-reward proposition in this space of the fixed income market, of the bond market?
I think, there was some sector restrictions earlier on the NBFC space, and which had been eased subsequently. Credit growth had come down from the 14-15% to 10% and is expected to pick up. With interest rates going down at the margin, that's going to give some bit of leeway for the borrowers to continue to come and borrow. So there is a little bit of, from the one point of side, there is a little bit scope for further credit growth. From the investor's perspective, given that duration has been a difficult play, both India and globally, it does make sense to be in the front end, in which case you go for the additional carry and you go and lap up this additional supply that is coming from this segment of corporates.
Understood. Thank you for that, Tanvir. So foreign ownership, as I understand it, of Indian government bonds is still on the relatively low side. So how does this perceived front-loading by the RBI, if it is a positive catalyst for foreign investors, how does that change the narrative from foreign inflows positioning point of view into the Indian bond markets?
So there is no doubt that at the margin, given that the lack of immediate trade in duration in India, foreign investors are unlikely to be so-called, let's say, trade or punt on the Indian bond market. So at the margin, their demand is going to be lower from that segment. We have previously discussed, and we all know that India has been included in global indices. So from the benchmarking perspective, as the other indices get included, like the FTSE as well, there will be some inflows into Indian debt in the medium term. And that part of the story remains. So I would say that in the near term, there would be a little bit of lack of appetite and demand, especially with all eyes will be on where the US economy and the Fed is going. But the medium term story remains intact.
And how is the bond market pricing in the fiscal end of town and fiscal management? And do markets reflect a belief that the fiscal deficit target for the current fiscal of 4.4% of GDP is achievable?
That is a very important point that you brought up, because at this point of time, people are ignoring the fact that we have been on a fiscal consolidation phase. The government has very credibly consolidated their deficit. I think they are very much on track with the budgeted 4.4% for this year. The RBI dividend only adds to some bit of buffer that the center would have beyond that. And given the expectation that the center will meet the target, the supply side of the government securities is well under control. So while there is the entire trade on rates from the inflation and the real interest rates perspective, the demand-supply dynamics are quite favorable. And at some stage when the domestic institutions look back to add duration to add those papers, I think the rate story could play out well. And from that perspective, I do believe that there is an upside to the Indian 10-year probably of another 25-30 basis points, more closer to that 6% mark from here off.
Thank you for that, Tanvir. Last question. I know this isn't really your wheelhouse, but let me just give it a go. Do you feel that this rate cut on the equity side and in secondary markets could stimulate IPO activity and could a lower interest rate regime perhaps increase demand from fund managers for new equity offerings? I know all eyes in the equities market and in the IPO market are going to be on HDB Financial Services, which is next off the cab rank in terms of a public listing.
Undoubtedly, equities should fare better with lower rates. And while the domestic demand continues and has been as robust as it can be, the foreigners have been net sellers of Indian equities. While Indian equities still trade at relative premium to rest of the EM and Asian markets, I think they're one of the most stable markets as well. And with this rate cuts, I think some bit of interest could reignite. I won't expect a massive interest from foreigners at this stage, but at the margin, yes. And of course, positive foreign participation, good participation by domestic investors should bode well for equities and respectively for IPOs. We would expect equities to do well at the margin during the year.
Tanvir, thank you very much indeed for that visibility on the equity market implications as well from the RBI rate cuts, that 50-pointer and the cut in the CRR. Excellent conversation, Tanvir, as always. Thank you very much indeed, sir. Tanvir Sethi there from Kotak Mahindra Asset Management Singapore. As we head into a break, we'll leave you with a look at how currencies are trading in early Asian trade. Inside India, we'll be right back. Welcome back. Vietnamese EV maker VinFast is close to opening its Indian plant. This as the company saw a seasonal fall in deliveries. JP Ong joins us now with the details. Good morning, JP.
Good morning, Sri. And yes, they did note that the first quarter deliveries came in lower than the fourth quarter. But VinFast has noted that traditionally the first quarter is usually one of their slowest quarters, hence that seasonal decline. But if you take a look at the first quarter EV deliveries, actually, it surpasses that of the entire first half of 2024, which indicates that revenues and sales and its expansion continues to grow at a faster clip. Now, VinFast, in fairness, also did report a wider net loss of over $700 million US. thus raising concerns. But right now, the name of the game, if you're in EVs in Southeast Asia, is trying to expand and hold on to that market share. We have to remember that VinFast is the dominant EV player in its home market, thwarting the likes of BYD also and maintaining a market share of more than 50% in that space. And they continue to roll out in places like Indonesia, the Philippines, and even that of India. Now, speaking of India, they did note also that they are still on track to open that plant, that CKD factory in the state of Tamil Nadu, and they said that it will be operational by next month or later in July. Now, this will be important for VinFast because while they maintain a very, very strong market share, that is, in Vietnam, they have a lot of catching up to do and possibly face a very competitive Indian market. If you take a look at some of the research by JMK Research for 2024, you'll notice that the Indian market is dominated by a lot of local players, including the likes of MG Motor and Tata Motors specifically. And if you'll also look at that as we wait for that chart to come up, actually, you'll also note that BYD only maintains a 2% market share actually in India, just indicating how competitive it's going to be. And as VinFast enters in the Indian market, they're going to have to step up their game to try and make sure they can claw some market share because, again, winning that market share and making sure they have a strong footprint in India will not be an easy task for the Vietnamese EV upstart. Sri, it's back to you.
Intense competition in the EV market in India, JP. You're quite right. And charging infrastructure is also another challenge. Thank you very much indeed for that. Right, macroeconomic factors are still very much in focus in Japan ahead of the Bank of Japan meeting next week. Lin joins us with more. Good morning.
Good morning, Sri. So we're looking at a couple of key dates here, the 17th, the 20th and the 23rd, with some significant implications for Japan's rates market. We're seeing the yields on the super long end today already pulling back, and this is off the back of reports that say that the Ministry of Finance is looking to potentially buy back some of these low-yielding super long bonds here. And again, this is looking at the correction of what we've seen as a technical imbalance between supply and demand. So this could come on top of a tweaking in terms of issuance plans coming up as well, but that hinges on the primary dealers meetings in terms of what they get for demand outlook going forward. That will happen on the 20th as well as the 23rd, keeping in mind as well that these plans to potentially buy back some of these bonds is subject to a separate approval in terms of the budget as well. So that's another wrinkle in there. But certainly this is the signalling that we're hearing that the MOF, or the Ministry of Finance, is willing to act to stabilise the volatility that we've seen in the JGB market. But still, Sri, of course, along with some of these shorter-term concerns, there is still longer-term concerns in terms of the fiscal sustainability outlook, particularly when you've got a Prime Minister that is under a lot of pressure, both from opposition parties, from the right-wing faction of the LDP, to do things like cut taxes, for example, ahead of that upper house election as well.
That's what's driving that volatility in the JGB market on the external side, on the political side, and of course the risk of a technical recession in Japan, as you noted yesterday. Thank you very much indeed for that, Lynn. Another story we're watching this morning, Starbucks is cutting prices on a range of beverages in China as sales remain sluggish. But local coffee chains are on solid ground and are expanding overseas. CNBC's China reporter Elaine Liu takes a closer look at China's homebrews.
China isn't much of a coffee country, but its homegrown coffee chains are now trying to win over customers globally. Luckin Coffee and rival Coty have expanded aggressively in China and even butted heads in a price war. Founded in 2017, Luckin has overtaken Starbucks in mainland China with more than twice as many stores. Their coffees are cheap, their business model more Silicon Valley than Starbucks, and their menus wacky and constantly changing, from alcoholic lattes to watermelon cold brews. But slowing growth in China has pushed Chinese companies to seek opportunities elsewhere.
Luckin's global expansion started here in Singapore, where it opened its first 2 overseas stores in 2023. And now it has set its sights even further.
Following in the footsteps of its rival Coty, which was started by former Luckin executives and already brewing in North America, Luckin is opening in New York City, 5 years after the company was delisted from the Nasdaq over an accounting scandal. In Asia today, Luckin's coffee can be as cheap as $2. But these chains aren't just competing on price. They're challenging the very idea of what a coffee shop is, according to China's strategy consultant Alison Malmsten.
When Luckin first started blowing up in China, we recognized it as a tech company that sells coffee and not just a coffee company. And this is because they're so focused on digitalization that ordering on the app is super flawless. Like you order, you go by the coffee shop, you pick up your coffee, no dealing with baristas.
Coty is offering steep discounts in New York. 99 cents for your first drink if you download their app. Over time, analysts think these Chinese chains will remain cheaper than Starbucks in America, but the price gap won't be as wide as it is back home.
Chinese companies, when they're going abroad, they're often willing to scale up, focusing more on capturing more market share than their profit margin, and therefore able to sell at a really low price.
In China, Luckin has huge facilities for processing and roasting coffee beans, making it cost efficient. But with tariffs looming, the company could lose some of that supply chain advantage. Add in staff on New York wages, and the costs start to pile up.
Despite tensions between Beijing and Washington, a bargain brew from Chinese chains could convert coffee lovers who are facing rising prices around the world. In Hong Kong, Elaine Yu, CNBC.
Let's bring in Elaine herself now. And Elaine, great report. So ultimately, how much of a rough ride do you reckon Luckin is facing in the US? And to what degree could it fall victim to this current round of trade tensions?
So it is certainly interesting timing for Luckin to make its New York debut soon. But in terms of geopolitics, New York isn't quite like Washington. And in these cities where they're facing really high cost of living, and in New York City, grocery prices have become so expensive that it's now a major talking point in the mayoral race. So at a time when prices are really top of mind, value, consumers are really looking out for these things across the world. Like in China, people have called it the consumption downgrade. And in the US, young people are set to be recession-proofing their lives. And so when prices are really top of mind for consumers, that could be it. Helping someone saving $1 or $2 on their daily Americanos, that could be what converts someone from Starbucks to Luckin, for example.
That's a great point on trading down, Elaine. And in the current economic circumstances, the luxury of a Starbucks or even a Luckin coffee could be the first to go. Thank you very much indeed. And you can read more about Elaine's story on China's coffee chains on our digital arm, CNBC.com. Inside India, we'll be right back after this short break. Welcome back. We are counting down to the market open in India, and this is how we are shaping up. Let's give you a glimpse of futures just before we get to the market properly. 25,246 is what is implied and indicated by Gift Nifty futures at the get-go. So if that does materialise, we're looking about 150 points to the good for the benchmark dollar-rupee exchange rate at 85.59. So clearly there is something of a post-RBI halo effect still to be had for the Indian markets. Now, Apple's latest software offerings at its developer conference failing to wow investors. Steve Kovac has the details.
Apple kicked off WWDC, its annual developers conference, on Monday with expectations already low for its artificial intelligence ambitions. And they were low for a reason. After last year's debut of Apple Intelligence at the same conference, Apple failed to live up to its promises, most notably delaying the AI update to Siri. So Apple played it safe this year, sticking to software updates it can reliably deliver. That means less AI and more general updates to the operating systems for iPhone, iPad, Mac, and so much more. The big change, a new design scheme called Liquid Glass, which is based on the software design for the Vision Pro. Now all of Apple's operating systems will have that similar look. On the AI front, some minor features, including new live translation, which automatically translates live text messages, phone calls, and FaceTime video calls in your preferred language. Apple also expanded its partnership with OpenAI for visual intelligence, which can now read the content on your screen when you take a screenshot. You can then use that for a web search. And developers are now able to tap into the Apple Intelligence system using Apple's language models, though we will have to see if they choose Apple's technology over the tools they're already using from OpenAI and others. Apple barely acknowledged Siri during this keynote, only saying it still needs more time to work on the AI update and teased more announcements on that coming soon. So with WWDC behind us, we look to what Apple can do with hardware, expecting the next family of iPhones to launch this fall. For CNBC Business News, I'm Steve Kovac.
Thank you for that, Steve. So how is Apple coping and cracking into the fast-growing India market? Let's bring in Deep Kumar Shah, Research Associate at Crisp Idea. Deep Kumar, so iOS 26 and integrating Apple Intelligence across the apps and the devices and the ecosystem is all very well. But is Apple and its rivals, for that matter, failing to grasp the importance of offering locally Indic, large language model, AI-enabled phones and apps? It was interesting last week because we spoke to Sarvam AI. They are addressing this challenge domestically. So does Apple need a strong local partner to make their AI proposition work and be viable in India?
Yeah, so basically, Apple is expanding in India with Foxconn, and they have highly invested in India with the 4 billion. And recently, they have also invested with a subsidiary called Use-On Technology with 1.5 billion. And we see here it's a massive 300 acres plant in Devanhalli, Bengaluru. So we can actually see the integration of AI and LLM markets, and here as of now it's an assembly unit, but it's a great exposure for India, and also it's a huge market for India as well. And considering the PLI schemes, government is also moving forward, and also Apple does need the local support from the Indian manufacturers, which can give the boost to the Indian government as well as the Indian Made in India concept. And yes. As we see, India is just making products in India. It's not only making products in India for an Indian consumption. It is also now making products for the world. The Make in India is now moving forward in the world. And as the CEO Tim Cook said that the majority of the iPhones sold in the US in the upcoming quarters will be coming from India. So yeah, we can see it's a huge it's a huge partnership with India. Yeah.
Agreed, Deep Kumar, but we have seen some mixed signals in terms of Apple's supply chain expansion in India. You mentioned Foxconn, and that's some positive development there. Contract assembler for Apple, it's set to expand in Tamil Nadu, but President Trump doesn't want Apple relocating manufacturing to India. Now we hear, again, positive development, Apple-Tata Group partnership. What does this tell you about how important India is for the overall Apple strategy, and have they got a coherent plan? Does Apple have a coherent plan to develop and grow in India?
Yeah, so Donald Trump has indeed publicly stated his intent to impose 25% tariff on iPhones sold in US and that are manufactured in India. But if we see the cost of economics, we can see that if suppose they're getting their iPhones from China, so they have this they have to upfront pay the duty of 20% and other tariffs. So the pricing of India it will be a more competitive for US market than the China made ones. And also if you see comparing the cost economics of made in US, so basically in India roughly the assembly cost will be somewhere around $30 per iPhone as per the research, and the same if we consider the labor cost in US, it will come somewhere around $300 to $350 per assembly of an iPhone. So if you calculate in that perspective, maybe they have to. I'm sorry. Like if we compare US, I feel India gives the more competitive pricing, and even Apple will also opt for that instead, which would instead of drastically increasing the iPhone prices, it will naturally deter the customers.
Deepka, it's interesting when you consider the narrative. So the challenge for Apple not only comes from President Trump's trade policies, but it also comes from China and Xi Jinping. From an addressable consumer market point of view, Apple cannot ignore a fast-growing market like India. But the problem is, it's Chinese smartphones, isn't it? From Oppo to Vivo to Xiaomi that are the top sellers. So how does Apple win market share in this intensely competitive environment?
Yeah, so as we see, Apple coming up with their innovation instead of bringing up the new models continuously. So every year they bring up new innovations, and recently we have seen in WWDC yesterday that they have delayed AI, but hopefully in September or in this fall we'll see a good OS design as well as the new phones which will penetrate the market, considering the AI as the major source of the selling and the innovation through the Apple. Yeah.
Let's get back to Tamil Nadu, because there is a sense, I mean, India isn't monolithic, as you and I know. It really depends on the state-by-state regulations, policies, incentives, and how they are configuring the production-linked incentives and the entirety of the Make in India policy. Yeah. Does it feel like Tamil Nadu is emerging as something of a blueprint and a model or a template at a state level to replicate the build-out of the Apple ecosystem or the supply chain and expansion in India?
Yeah, Tamil Nadu plays a big role, as well as the Bangalore and the Hyderabad unit also. So we can't, if you see as in India, yeah, it creates a major impact on the overall India, like being from the South Indian state, and now they are being targeted as the, they have the huge plant for the Apple production, as well as currently we are seeing even airport productions are also being lined up there. So yeah, it's a huge opportunity for Tamil Nadu as well. And as we see, we have seen that 1.6 billion dollars has been invested. So yeah, the great opportunities are coming for Tamil Nadu.
Deep Kumar, you mentioned how the developer conference for Apple was somewhat disappointing for the market and the community because there didn't really seem to be anything transformative in terms of Apple Intelligence or the AI rollout. How much of that is a problem for India? Sarvam AI clearly seem to be doing some great work in that regard, but Apple, does it have a plan in terms of an Indic language, large language model that can kind of plug into the AI-enabled phone ecosystem that it's developing or trying to develop in India?
Yeah, so we can see the regional languages in the AI or in AI also. So yeah, looking forward to it. We still have to see how their launch of new Apple's iPhone 16 goes. So we have to watch and we have to see how it goes. Yeah.
It is a big challenge. Deep Kumar, great insight, sir. Thank you very much indeed for joining me on Inside India. Deep Kumar Shah from Crisp Idea. Thank you. Right, we are counting down to the market open in India. We'll bring you some of the early movers when we return. 2 minutes. Welcome back Inside India. Indian markets just joining the trading day. Let's take a look at the benchmark. Nifty 50 is knocking on the door of 25,200. So clearly there is still a post-RBI halo effect here going on the equity side, up by 0.4% just at the get-go. Let's give you the dollar-rupee exchange rate sitting at 85.5740. Now, shares of HDFC Bank, India's largest private sector lender, looking like this, up by just a fractional 0.2%. Lilavati Kitral Mehta Medical Trust, which owns Mumbai's well-known Lilavati Hospital, alleged that the bank's CEO, Sri Jegarajah, and 8 others misappropriated the trust's funds. HDFC has defended its CEO and said the Mehta family is targeting its top executives. Jegarajah has been with HDFC Bank for nearly 3 decades and was named CEO back in 2020 and then reappointed in 2023. Let's give you shares of Tata Motors, the company pledging to invest over $4 billion in its EV business over the next 5 years. At the Tata Motors Investor Day, the company said that it plans to increase the number of models in its range as well as invest in improving vehicle tech. Across the board, Tata hopes to increase its market share from 16% to between 18 to 20%, and it hopes to regain ground on rival Mahindra and Mahindra, the stock up by, well, let's call it flat at 719 rupees. Now, India is on a drive to achieve 500 gigawatts of renewable energy capacity by the year 2030. As of March this year, it has reached just under half of that target, and there is doubt if it will hit its 2030 goal due to challenges in expanding the grid infrastructure, land acquisition, investment and regulatory hurdles. Let's talk through these challenges and the possible way forward to reach that target and bring in Linda Jung now, Senior Analyst for Power and Renewables at BMI, joins me here at the SGX. Linda, welcome to Inside India. Thank you for joining me. So, India aims to achieve 500 gigawatts of non-fossil fuel-based clean energy capacity by the year 2030. Ambitious or achievable, or what needs to change or improve to get there?
Yep. Quick answer, it's a very ambitious, lofty goal. So to put that into context, India has to add about 50 gigawatts of renewable capacity every year by 2030 to hit that target. In 2024, it's a record additions year, and we've only seen under half of that, 25 gigawatts. So very ambitious. It's riddled by a bunch of challenges. Grid capacity constraints is a big one, so challenges in infrastructure, as well as delays in signing agreements, actually getting these projects into execution. So that's a massive hurdle that will, we believe, make India fall short of this goal.
India is concurrently planning to add 80 gigawatts of new coal plants by 2032. So that's hedging to a large extent because of the importance of reliable supply and this issue of intermittency too. Does that tell you that policymakers themselves recognise that the current frameworks need to be changed and may not adequately support 500 gigawatt renewable approach?
Yeah, exactly. So India's coal capacity will continue to increase, albeit at a slower rate. And sort of India's approach is to ensure that it has overcapacity that includes coal, and in addition to renewables, just because of all of the issues that the intermittency of renewables bring. So before it can with assurance have that baseload capacity, India will be slow to phase out coal, slower than expected.
Can a US-India trade deal perhaps act as a catalyst to achieve India's renewable objective, or does it stand to complicate scaling renewable energy in India, given how solar power has become such a hot potato in the trade arena?
Yeah, exactly. That's a very great and very on-point question, very relevant. So the recent US solar tariffs imposed on 4 ASEAN countries, which have accounted for over 80% of US solar imports, and these are Vietnam, Thailand, Cambodia, as well as Thailand. We think that supply chains might shift to India as a result of these tariffs, making those imports from those countries very uncompetitive. India is also having a lot of domestic manufacturing policies to really boost its local domestic manufacturing capability. So India does have a huge US market to export to, and definitely an area of opportunity for growth.
We've talked about how coal inevitably still needs to be part of the transition story. Is there room, or is there a narrative, and how convinced are you that clean coal technologies, carbon capture, sequestration, can help sort of mitigate those concerns, very real, legitimate concerns from environmentalists that, look, nothing has really changed here, and this is self-defeating if we got coal being part of the solution?
Yeah, because BMI thinks that, we agree with that, and if you look at the companies really pushing for carbon capture and storage, it is really the oil and gas companies to upstream and not renewables per se. And if you look at the economics of it, it just hasn't financially taken off to a point where it's viable. So if you look at levelized costs, if you include the cost of coal with carbon capture, it's actually a lot more expensive than solar, especially with the cost of batteries coming down year on year. So it is not economically viable, and we do not think that it will go on to a path of widespread commercialization, CCUS.
We were talking about the AI revolution, and India is no exception, and it's in a nascent stage, but there is a data center build-out underway in India. And you and I know, Linda, that this is extremely energy intensive. How does that change the narrative in terms of the transition that India is undergoing? And again, controversial, but should nuclear be part of the story as well?
That's a great question, Sri. The short answer is yes, and the India government sees this as well, very aware of it. And it's in its recent India budget, 2025-2026, released in February, it has set very lofty goals for nuclear by the next decade. So with the rise of new novel technologies as well, such as small modular reactors, India is at the forefront of nuclear development, and clean round-the-clock baseload is becoming increasingly important for data centers to run. Yeah.
What is the workaround then, as you see it? And let's start with the grid capacity constraints. What can policymakers and the public and the private sector do in collaboration to overcome these challenges on the grid side?
Great question, Sri. For the grid side, it is really the public sector that's pushing grid expansion, grid upgrades, connectivity, building new transmission, distribution lines. Because of the nature of where distribution companies, which are sort of in charge of grid build-out, are owned by the public, DISCOMs, and they're not privatized. Despite there having been talks, over the years of privatization, we just haven't seen it yet. Except in a few states such as Delhi. So there is a limited amount that the private sector can do in terms of grid, but there are other new technologies such as batteries, storage, that can sort of address these intermittency issues that comes along with renewables.
What does it mean for domestic pricing as this transition gets underway with the challenges and the opportunities and the workarounds that are necessary? Does it mean that businesses and consumers will have to pay more, perhaps, for their power?
So there are a few elements to this, and there might be opposing forces. Let me go into it. So India is predominantly reliant on coal, and BMI's oil and gas team forecasts coal prices to actually come down, see a downwards pressure in the next 2 years. So that's on the bright side. However, on the less bright side, solar and renewables is becoming increasingly important. And with India, one of the contexts is India is relying a lot on building its domestic manufacturing for solar panels. And that is a lot more expensive than what they are used to, which is importing cheap Chinese solar panels. So that will definitely add to increasing cost pressures, as well as a small increase in reliance on gas, which is set to increase over the near term. So overall, we believe that prices will see a slight increase over the next 2 years, but that's also limited because of how prices are set by the state regulators.
And are you seeing anything transformative in terms of storage solutions? Because when it comes to renewable, the common perception, or perhaps misperception, is that it cannot meet baseload demand. You need LNG, you need coal. How far are storage solutions within the Indian context enabling storage of renewable power to meet that base load?
So at the moment, storage is still lacking, massively lacking to meet the demand required for renewables. However, we do see trends in, for example, auctions and tenders by the government, where storage projects and hybrid projects, for example, solar and wind hybrid, that can better serve round-the-clock power, are becoming more and more under the spotlight. So actually, a vast majority of projects fall under this hybrid and storage category. there is increasing, attention on this, but it will take a number of years for it to develop to the scale that it really needs to meet that of renewables rollout.
And we often hear about LNG being the transition fuel. Does that hold true for India? I mean, it is still a fossil fuel, but it's a less polluting fossil fuel, and the oil and gas industry do like to, for want of a better expression, put it on the pedestal. It is invariably going to be part of a US-India trade deal as well, yes. I would imagine. How would you characterise the role that LNG plays in supporting the transition?
So currently, the share of LNG in India's electricity generation mix is maybe 1 to 2%, so a tiny fraction. We do not believe that this will increase significantly, even over the long term, just simply because the prices of LNG are really high compared to coal and even that of solar. And as a matter of fact, a lot of the LNG power plants in India, they have very, very low utilization factors. So about 20%, when usually these plants can run up to 60%. So even though they have the capacity, they are just simply not using it for generation due to the high cost.
Interesting perspective, Linda. We'll leave it there. Thank you very much indeed for joining me on Inside India and talking about the challenges associated with renewables transition in India. Linda Zheng there from BMI. Right, let's give you a final check on the Asian markets before we go. And we are seeing some confidence in the APAC region, with the exception of the Straits Times, the index here domestically over here in Singapore, which is, let's call it flat, at around 3,931. Right, I'm afraid that's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.